Hi, thanks for joining me again. When I made my last video, I talked about some fairly complex chart analysis. This was the chart that I looked at in particular, and we looked at narrow spreads and high volume and widespread high volume. When you look at a chart, you can see lots of different variables which you need to all put together to understand what's really going on. You need to know what the average volume is, so then you can recognize high and low volume. So on this chart there's a line here that shows the average volume. It's a 14-day average. And you also need to know approximately what the average spread is. You don't need to know exactly, just by eye. So you can see that this is probably the average spread on this chart. If you're looking across, you can see the average spread. These are all average. Pretty obvious there about average. Something like this one. Now the hollow part of this bar is a gap. I put that in so you can see the true range of the bar. The coloured part is the traded range, where the trading was done on that period. It's a daily chart, so a day, during that day, price traded where the coloured part of the bar is, but it gapped down from the previous close, and that's the hollow part of the bar. And it's slightly above average, and the volume is slightly above average. So that got me to thinking, should I be really making something that showed more about the basics of chart reading and then work my way up to the more complex and advanced chart reading? I'd never done anything basic before, so I made this as the first example. This is the price bar, obviously. This is the spread or range, and at the top I always think, now this is not exactly right, but this is how I think of it. The high of the bar is where resistance was found in the market on that particular bar for that period of time. So if it's a daily chart, on that day, here's where resistance was and price couldn't go any higher. And down at the bottom, here's where support was and kept price from going any lower. Now if this was a 1 hour chart, for that period of 1 hour, that was where resistance was and that was where support was. If it was a 5-minute chart, same thing. This is where resistance was, this is where support was. Let's just say it's a daily chart for now. Now, any bar, you expect to have approximately average spread matching fairly equally with average volume. This is what's expected in the market. And the close represents an equilibrium in the market where the buyers and the sellers were fairly equally matched and prices closed, in this case, in the middle. And when you're analysing charts, in some respects you're trying to determine the sentiment in a market. Or if the sentiment is strong, you would expect the market to go higher because demand will likely be stronger than supply. And if the sentiment is weak, you would expect the market to go lower. You would expect supply to be stronger than demand, and that would push the price lower. And on average volume, you can be pretty confident that that's the case. If you've got low volume, and the spread is still matching the lower volume, the mid-bar close is a little softer. It's you can't be so certain that there really is an equilibrium in the market. It may have only been because of the low volume. There wasn't a lot of activity in the market, so you don't get a broader look at the underlying sentiment in the market. Whereas high volume and a mid-bar close, you can be really confident that there is an equilibrium between the buyers and the sellers in the market, and that's left them right in the middle. Neither side gained the upper hand, and that's left a mid-bar close. So higher volume is higher activity in the market, and it also represents more force or effort being exerted in the market. And if that results in a mid-bar close, then there really is close to a balance for the period of time of this bar. Let's just say it's daily. On this day, there was a balance reached between buyers and sellers, and neither side could gain the advantage. If you have a bar where the close is up near the high of the bar and volume is average or higher, you can generally take it that, but all things being equal, the buyers gained the upper hand and closed the market higher. Demand was stronger than supply. And the same on this bar. On volume that is average or higher, without going into any more detail than the raw bar on its own, sellers were in control and they carried price lower, and it's closed down near its lows for the period of the bar, or daily in this case. So following that, I made this chart, and this is showing that high volume you expect wider spreads, average volume you expect average spreads, and low volume you expect narrower spreads. This is what's expected. And over here we have some anomalies. And in chart reading we look for anomalies because they're often significant and they tell us something that's going on in the market. So the first one we have is a narrow spread but very high volume. That's an anomaly. If it's very high volume, you expect a wide spread. And same again on the next one. Narrow spread, high volume. The only difference being you've had a high close on one and a low close on the other. And to understand what's going on, you really need to start putting things into context and looking for the response. But we'll just move across for the minute. Now we've got a wide spread on low volume, and same again, wide spread, low volume, the difference being the high close on this bar and the low close on this bar. This one's a bit easier to understand. Generally, a wide spread on low volume means there's been some sort of imbalance in the market. On this bar, you would expect that selling pressure was low and buying pressure was normal or average, and because there was low selling pressure, price was able to float up during this period on relatively low volume and close high. So this is an imbalance between buyers and sellers, or an imbalance between supply and demand, where selling pressure was low, buying pressure was only considered to be normal because volume wasn't very high. So what we're considering is that if volume was actually average, half the volume would be buyers and half the volume would be sellers. It may not always be like that, but we're just looking at that as really simple terms at the moment. And half the volume is missing, and this is what the price did on half the volume, half the average volume. So you have to consider that price has gone up strongly on very low volume. So there must have been a lack of sellers in the market, and just average buying carried price higher with ease. So now, are you up with me on the next one? Price has fallen lower on very low volume. You've only had half the volume again, half the expected volume, but you've got a very wide spread. There was very little demand in the market. and what selling pressure there was made price stretch lower to find sufficient buyers to satisfy the sellers. This is a fairly common thing to see, especially in less than liquid markets, where for a period of time or for whatever reason there's an imbalance in the market and price moves with wider spreads than expected, considering the volume or the effort or the force behind the volume in the market. And the third example over here is average spreads, very high volumes. Now, this one would be best termed as excessive. You never really want to see excessive volume, or if you do, you should be really suspicious of it until you see what the response is. Now, in this case here, imagine if price had been moving higher for a period of time on average spreads and average volume, and all of a sudden you got really high volume on an average spread. You got really excessive volume for no apparent reason. You should be suspicious until you see what the response is. It might just be all buying and it might be fine. More than likely, excessive volume, really excessive, if it's just slightly above average, it's not really excessive. I'm talking about really high volume that's all traded on market. It's not some off-market trade that's happened between two people that's just been reported on that day. The day's price action has played no part in that higher volume. I'm talking about volume that's traded on market and the price action is representing that volume. Generally, when you see average spreads, excessive volume, you should be suspicious. It's full of selling. It's probably a good news announcement, and the market is using that good news announcement and the demand that's been created from that good news announcement to sell into the demand. And if the next bar was then down in response, that would probably confirm what had happened. And same with excessive volume when price is moving lower. If price had been moving lower for a period and then all of a sudden you got average spread, very high volume like this, you would have to wonder whether buying has come into the market. You need to see the response to fully understand what's happened, but if you got a response like this, it would probably help to confirm your suspicions that strong buying had come into the market after price had been in a downtrend for a period. Now, back to this one. Very narrow spreads on high volumes. If price had been moving in an uptrend for an extended period of time and you were suspicious at some point that some profit taking might come in and you saw a narrow spread with a very high volume, you would have to consider that selling had come in. It generally means selling. Sometimes it means absorption if you've got trading to the left which needs to be absorbed, like let's say that this trading over here was people that had been locked into positions and they've been waiting for price to come back up to them and saying, when price comes back to my level, I'm going to get out. Sometimes this will happen. You'll get a narrower spread, high volume, as the market is trying to absorb its way back past an odd congestion area, and had been trading generally on average spreads, average volumes, and then you get a narrow spread up bar on very high volume. It will generally tell you that some selling has come into the market. Whether it's serious selling, only the response will tell you. The next bar, if it was down like this, closing below this bar's low, you would certainly have to be a little concerned that that's what's taken place. And exactly the opposite on this bar. If the market had been moving lower for an extended period of time and you've been just sitting quietly watching it and spreads had been average on average volume as prices moved lower and you've been waiting for some sort of buying or demand to come in, and you see a narrow spread down bar on excessively high volume like this, you have to wonder whether demand has come in. Strong demand, especially if the response looks like this and it closed back above this little bar's high. Narrow spreads on high volumes are generally significant. You should take notice of them and watch for the response. If you haven't worked out straight away what might be happening, the response will generally tell you. Okay, and just finally, here are some 2-bar combinations. Now you can see on this first bar here, prices travelled from where we said earlier resistance had formed. Price had travelled down, found support at the bottom and closed just off its lows. When this range is created, for a period of time, trading is relatively quiet within the range of a bar like this. The trading's all been done. In this case, the sellers sold to the buyers and pushed price down lower. And trading is relatively quiet in this zone, at least for a short period of time. It's like a safe zone. And in this case, this allowed price just to float up a little higher the next day within this relatively safe zone, and you can expect was probably on reduced volume. When, however, a bar closes below the previous bar's low, where support was initially found on this bar, but that support was broken and price was carried lower on the next bar, you should pay attention to that. It's a negative outcome. It's not necessarily bearish, but it's a negative outcome. The sellers were able to break below the previous support found at the low of the bar and close at a lower level. It is a negative. And the opposite on this bar was able to break above the resistance created at the high of this up bar and close higher. This is a positive. It's not necessarily a bullish sign, but it's a positive sign. It's a sign that the buyers were able to break above where the resistance from the sellers was formed the day previous. These are important combinations. It's a relatively safe combination when price trades inside the previous bar's range. This is called an inside bar, and an inside bar is less significant. It's easier for a market to trade inside the previous bar's range, especially if the previous bar's range was average or wider and you've had a narrower spread bar trading inside it. Whereas on these two examples, price is broken below or above the previous bar, and these are negative or positive outcomes in the market, not necessarily bearish or bullish, just negative or positive. In the first example, the sellers took control and broke below the previous bar's low. In the second, the buyers took control and broke above the previous bar's high. These are very simple 2-bar combinations, but you need to understand the principles that are happening in the market, and from there we can work to more complex outcomes. Now, I haven't done very many basic videos before, and I've started wondering if I should have done so before I began the more advanced chart reading techniques I normally look at. Let me know in the comments if anyone's interested in a few videos that cover the basics of chart reading, from not even having seen a bar chart before and right through to the more complex and advanced techniques that I sometimes show. Okay, that's my lot for today. Hopefully you found the video interesting. Let me know in the comments. Thank you. See ya.